Good afternoon. I'd like to welcome you all to the FIX 101 Trade Life Cycle. This session has been put together by our FIX Next Generation steering group. And FIX Next Generation was set up about 3 years ago to bring through a new set of members and leaders for the FIX trading community, as we rely very heavily on volunteers to do the work and to develop and protect the protocol. So my name's Maria Netley. I am the EMEA Regional Director for FIX Protocol. Before we start, I'd just like to introduce you to the panelists today, who have like to say thank you very much to them for putting together this presentation, and there's been a lot of hard work being put into it by them. So on our panel today, we have Charlotte de Cooper from Red Lap Consulting, Alex Ings from Credit Suisse, Sakina Lalji from Aquis Exchange, Rachel Shabilsky from Man Group, Merlin Raja from ABSA, and Christian Schmidt from EuroCCP. Thanks, guys. Over to you.
Thanks very much, Maria. So welcome, everybody. I thought it would be useful to start for any newer entrants to the industry that are joining today with a quick recap on what FIX is to start with. So the FIX protocol is a trading language or messaging standard comprised of a series of technical specifications agreed with members of the FIX community. FIX was first introduced in the early 90s by a series of a group of volunteers from several banks and investment management firms, with the aim of creating a common messaging format for equity trading. Today, FIX estimate that the vast majority of equity trading globally involves FIX at some stage in the trading process. Since then, it's also been expanded to cover other asset classes, although today equities will be the main focus of what we'll be covering. So before we dive right into the whistle-stop tour, if we call it, of the trade life cycle, a brief overview of what's to come in the next 30 minutes or so. So on the screen at the moment, you'll see a few examples of key stages in the trading process, including origination of the order starting from the buy side, that order being passed on to the sell side, what the sell side then do to it, for example, sending it to the trading venues that they have available to choose from, and onwards to trade confirmation, clearing and settlement. And you'll also hear about the importance of market data. Today's session will be mostly from the perspective of orders originating from the buy side, but of course we're keen to stress that there are other stages in the process, so no two trades will necessarily go through exactly the same process. For example, some of you will be aware about market makers or liquidity providers and the key role that they play in the trading process as well. I will add there will be time for questions at the end, and we like to take a stance of saying that no question is too stupid. So if you have a particular question in mind, chances are there's someone else on this call today that might have a similar question. So with that covered, I'll avoid saying next slide, please, and we can get stuck in instead. Thank you, everybody.
Hi, everybody. My name is Rachel, and I'm going to introduce the first step in the diagram, which is the buy side cycle. So here on this slide, you can see that there are two cycles, and the first is the investor. So this is where we start. An investor has a decision to invest, and then they have to consider how to build their portfolio. And this portfolio building will be based on multiple considerations. For example, what kind of product do they want to invest in? How diversified will the portfolio be? What kind of trading style do they have? And then, of course, on top of that, they have to consider the risk profile that they're willing to take and how they might choose to invest in terms of the vehicle choice and weightings across the investments. And then they pass this on to the portfolio manager. Now, the portfolio manager will take this and practically repeat that process, but at a more micro level. So what the portfolio manager does is build the portfolio based on those considerations, and again, go into more details, such as what kind of fund type they'll invest in, what sort of investment strategy, again, trading style, and look at things like specialisms. Do they want to focus on sectors, geographies, certain market caps? And of course, another popular topic, as you're probably most aware, is the ESG overlay. And then they also have to, sorry, something. Thanks. Obviously, then the portfolio manager has also got to look at the risk profile. So how much leverage would they want to use as part of that portfolio? And finally, they'll look at the timing, the size of the investment, and how to implement. Next, please, Maria. Okay, as I mentioned, the portfolio manager will be looking at different types of funds to invest in. Now, this slide is just high level and to give you an overview of the types of funds that can be invested in and what might constitute the reason for choosing a fund. Now, you can go into a lot of detail on this topic, so we won't do that today. That probably could be a whole session by itself. But as you can see, that the fund manager will be looking at obviously return for the investor weighed up against a sort of diversification and risk profile. So what does a portfolio manager have available in order to make an investment decision? They might have information on IPOs and private placements. Quite often they'll use specialist providers who give them information on a particular company itself. Those people will be specialists at those firms giving out information for potential investors. In addition to that, they'll have their broker research and any other independent kind of research, and that will provide a view on different stocks and sectors, which will enhance the portfolio manager's ability to make a decision about the whole portfolio. And on top of this, obviously, there'll be the in-house analysts who will also use their own expertise. And then what they'll have to do is build that whole view and model based on the consensus of all of the data. Then we'll move on to how they actually execute. So internally, the portfolio managers will talk to the buy-side dealing desk, and the desk will then have to take the trading rationale as given to them by the portfolio manager. So for example, there might be a quite short-term trade that needs to happen, and that will require obviously speed of execution to capture that liquidity, or it could be a sort of longer-term play, and they will have to minimize the impact and the cost of execution. Now, when they choose how to trade, they have various ways they can get liquidity. For example, the sell-side dealers will be showing indications of interest IOIs. There are also obviously lots of venues that they can go and get liquidity from. And in all cases, they will be considering obviously past performance of their brokers. They might be using algo wheels. They might be using the sales trader at the sell side. And obviously all of these things, the others are going to go on to tell you in more detail. So the next step is that they obviously have to pass their orders on to the sell side, and that's where the fixed messaging comes into play. Alex.
Yeah, so we're going to look at how the buy side interact with the sell side, and this is where the fixed protocol really comes into the picture. So first we'll look at a sample fixed message for those who are less familiar with this. There are 4 parts to a fixed message. Firstly, the tag, which is a number that represents a particular field name and meaning. An equal sign, the data value of the field, and then finally a delimiter, which is a start of heading character, usually shown as a hat or a pipe. So in this example, we can see a number of tag value pairs, which together make up a fixed message. There will always be important header fields, such as tag 35, which is the message type. That will show whether this is a new order, an execution report, etc. In this case, we're looking at a new order single message, which, as the name suggests, is a single newly created order. As well as other technical fields, there will be order economics, such as tag 38, which tells you the order quantity, and tags 40 and 44, the order type and price, which will tell you whether it's a limit order and therefore the limit price, or whether to execute at the market price. So how does the buy side interact with the sell side using FIX? Once the buy side have decided which broker to execute with, they will send a new order single or a new order list message. That's in the case of program trades, which we'll come on to later. And that'll have economic details of the order, for example, the trading account, the symbol, side, size, and price of the order. The sell side will then send back execution report messages, initially to acknowledge the order, and then one or more executions, which will include the quantity and the price of those executions. Other important fixed tags that will go back to the buy side are tag 29, last capacity. This provides the capacity the broker is trading under. In Europe, under MiFID II, this is driven by the MiFID capacity, so deal or match, for those of you familiar with the regulation. Tag 30, the last market, so this provides the MIC code of the venue that the execution occurred on. And tag 851, the last liquidity indicator. So this details whether the execution was a result of a liquidity provider providing or liquidity taker taking that liquidity.
Thank you. Hello, everybody. So today I'm going to share a bit about the various desks on the sell side, how they operate and interact with the buy side, fix up, and exchange. In order to talk about these desks, let's take a step back and from an aerial view, see how these messages flows to and through the various desks. Now, before I start, let me caveat this by saying there are several ways which a buy side to exchange workflow can be achieved. A range of connectivity options and protocols exist, such as direct physical fiber links, between the buy side and sell side, fix hubs, EMSX, shared infrastructure providers, native protocols, and much, much more. The setup within the desks on the sell side might also differ. The example that I'm, however, walking you through today is very vanilla and a standard fix workflow. With that said, if we take a look at the diagram in front of you, the fixed order message originates from the buy side, firm which Rachel had taken you through earlier. These orders are typically generated on the back of research and or market movements and results in the trader or portfolio manager making investment decisions. The specific order is then routed to the exchange trading member via the FIX protocol. How is it routed? Due to the robustness and security requirements, you find that the carrier is often a lease line fiber purchase via an accredited network service provider. There are many ways this could be routed to the exchange's trading member, but the most commonly used method is via a FIX hub provider. So what is a FIX hub provider? They act as the central party between the buy side and the sell side firms for fixed messages and can route the buy side messages to the sell side firms and vice versa. I say vice versa because more than just an order moving from buy side to sell side, there are other messages that need to be routed, such as cancellations, acknowledgements, amendments, trade messages, and much, much more. Tags within the message dictate what type of order this would be, for example, market or limits, along with price, size, time in force, etc., and can be quite extensive when sent to interact with the sell side algos. This message, depending on the offering of the sell side, can typically be routed to one of three desks. So let's talk about the high touch desk. This desk comprises of highly skilled traders and sales traders. These traders constantly interact with the buy side via Bloomberg, phone, email, providing them with color on the market at various parts of the day. The trader knows the instrument prices like the back of his hand and intuitively can tell when there's natural flow, internationals, and a large buyer or a seller moving the market. Moving the market. The sales trader spends a substantial time trying to cross up large blocks of trades between various parties and themselves when taking on risk. When the order is received from the client, a limit price is most often attached to the order, and the discretion in terms of how to cross up and where to cross up those stocks are left to these professionals. The other two areas form under the banner of electronic trading and are referred to as low touch, given the supposedly less required input from someone on the sell side. Debatable, but nonetheless, so direct market access. This method of order routing is by providing the buy-side client with the capability to execute directly onto the exchange, but via the members risk layer. Again, there is other solutions we could start talking about, like sponsored access, but I'll leave that for a 1 or 2 session. The incoming fixed order will pass through a member's risk layer, and parameters like price, quantity, size, notional value will be checked within milliseconds to sub-microseconds, depending on the client's requirements. The full trading pattern and style is left at the client's discretion. There are Chinese walls within the sell-side firm, and the high-touch desk cannot see what the electronic trading business is doing, both DMA or PT. A large part of the business is co-located clients, as they do not want other execution services other than direct market access. Program trading is the second part under the electronic trading banner or low touch. This is where clients of the sell-side firm send through orders to and via the program trading desk. These are super smart people, and they have a deep understanding of market structure, trading systems, OMS, EMS, co-location, low latency, and much, much more. Typically, the algos are used, algo used are VWAP, TWAP ratios pairs by these clients in order to trade the market with minimal to low impact. You find that the electronic trading fees are at a discount to the high touch trading fees, and clients tend to use this service in the back of research to lower the average basis point spend. Smart order router, you'd see that little cog in between the sell side and the venue. And the venue, when we speak about venue, it's not only formal exchanges. It could be, systematic internalizers. It could be MTFs. So a smart order router, and it's a wonderful time here in South Africa where we see this starting to play out now with competition for the JSE with the new exchange Atrix, which is powered by the Aquas technology. We see brokers looking to implement smart order routers that will help decide which exchange an order should be sent to. This can be configured in several ways based on price, depth, cost, and much more in order to achieve best execution for the client. While execution algorithms interact with the exchange primarily with native, we still find the largest part of these desks when interacting with firms other than HFT or prop firms is that all 3 desks receive a majority of the orders via FIX. Thank you.
So now I'm going to run through a few of the ways that the buy side used to determine how to route their orders. So first up, indications of interest, or IOIs. These are used by the sell side to indicate liquidity or potential liquidity to their buy side clients. There are 3 main types. Client, which is where the sell side has either block liquidity or a large order being worked in the market from another buy side client that could be matched up. Potential, this is where the sell side's client has communicated interest. There's no firm order, but a reasonable expectation that they would trade. Or house, and this is split into 3. Firstly, unwind. The sell side needs to unwind some existing inventory. This is understandably less well used due to the risk of signaling that kind of large position to the market. Position wanted, where the sell side wants to build a position in the stock for the purposes of meeting expected client demand. And market making, which is proactive liquidity provision or facilitation from the sell side. Most IOIs are executed against by the buy side speaking directly to their sell side sales trading contact and either placing an order verbally or electronically. The trading desk will then manage the matching of the 2 sides, either as an SI execution, and we'll get to that a bit later on, or by bringing the 2 client orders onto a trading venue to match there. There's also the concept of actionable or click and deal IOIs, whereby the buy side can select an IOI in their OMS or EMS to execute, and this will then send an order to the broker to automatically execute against. And these tend to be in smaller sizes than standard IOIs. There are a few important fixed tags for IOIs. That is the message type to indicate a particular IOI message. And there are other IOI specific tags to determine IOI type and the natural flag. Next, we have algo wheels. So algo wheels are pieces of software used by the buy side that automatically select the optimal broker or algorithm for a particular order based on a list of preset conditions. These days are offered by most OMS and EMS providers. So the buy side will define the conditions of how to route, and the software will pick the broker or algo most suitable depending on the order. These tend to be best suited to order types that are repetitive and do not require any manual discretion, as there is little human involvement outside of setting up the conditions initially. Brokers that will then compete for a place on the algo wheel based on historical execution performance, and the buy side will regularly evaluate this in order to remove or add brokers to their wheel. This allows the buy side to evaluate broker performance side by side against each other. And with an increasing focus on best execution, this provides the buy side with an easily defensible process for how trades are allocated, as this is done based on systematically evaluated performance.
Thanks, Alex. So Alex showed this slide a few minutes ago about what happens and how the orders flow from the buy side through to the sell side and their brokers, and what the brokers then do with that. For example, sending those onwards to the venues. But what are the trading venues? What does that catch-all term cover? Trading venues typically refers to exchanges, regulated markets, or MTFs, which stands for multilateral trading facilities. You then have subcategories, sometimes referred to as trading mechanisms. Those can include specific services offered by those venues. For example, lit continuous trading, dark order books, and auctions. And then you get various types of auctions, for example, opening, closing, intraday, or periodic auctions. And then you have systematic internalizers, which are another option that you will hear about shortly. So here in the center of this slide, you'll see some icons representing examples of those execution venues, exchanges, lit books, dark books, and so on. Messages, including orders, modifies, and cancels, are sent by the trading firms or via DMA, direct market access, to the execution venues of their choice. The next steps happen simultaneously. So on the bottom left-hand side, you'll see the venues returning acknowledgements of those messages and executions via the execution report messages. Venues will typically add further tags onto the message back to the member. So for example, a few that you'll be familiar with or you'll have heard mentioned are tag 30, last market, tag 39, indicating the order status, whether it's partially matched, fully matched, and so on, and something like tag 151, which indicates how much quantity is left over. On the right-hand side, you'll see what happens on the market data. So details of those orders and trades are also sent by the venues to their public market data feeds for transparency purposes. There are exceptions to that, for example, where certain venues or dark order books or trading mechanisms operate under a transparency waiver, meaning that they don't need to publish certain information. Market data can be seen also as the start of further trade cycles as trading firms and their algos react to the market data and continue to send further orders. Last but not least, trades are sent by the venues to the CCPs, which stands for Central Clearing Counterparties, and that is for clearing purposes. Again, there can be exceptions. So if a member, for example, requests that they want clearing to be suppressed for where they have traded with themselves, then those trades would not be sent to the CCPs. Not shown on here, as I mentioned earlier, there are examples such as fixed drop copy feeds, which are an optional feed that members can request from a venue, which would include details of all of that member's own orders or trades. And that would typically be used for risk and compliance purposes. The message flow is slightly different for systematic internalizers, which you'll see on the next slide.
So we've heard the term systematic internalizer or SI a couple of times. What exactly are they? So SIs are registered entities that are able to commit their own capital in order to execute orders. The SI concept was created under the original MiFID regulation back in 2007. And any entity registered as an SI has an obligation to provide pre-trade transparency by publishing public quotes for all liquid stocks that they are an SI in. SIs have proliferated under MiFID II due to several factors. One is the share trading obligation, or STO, in which all trading has to be performed on registered venues, and that includes SIs. The quantitative approach that was introduced to SI determination, and due to the complexities in this determination logic of how firms determine whether they are or need to be an SI, in practice, many firms opt in to be an SI in all relevant instruments. And a trade reporting obligation. So SIs always trade report, unless there are two SIs trading with each other, and then the seller reports. This takes the trade reporting obligation away from the buy side, many of which are not set up to do so. There are two main types of SI, bank SIs. There's a couple of examples here. Now these generally provide block liquidity from either their high-touch desk or central risk book, and electronic liquidity providers, or ELPs. These often provide both public and private quote streams and are often themselves market makers on exchanges. There's a few important fixed tags for SIs. On the inbound, a combination of tag 2594 and 2595, which tell the receiver whether the sender is an SI. This is important for the trade reporting obligation. And on the outbound, tag 574, which tells you that the execution was done against an SI, and tag 2524, which tells you whether that execution has already been trade reported or not.
Cool. So we've heard then of the various stages in the life cycle, including investment decision, execution styles, and choice of venue. So I guess the last leg, as it were, in the trade life cycle would be how do those trades clear and settle. So up step the role of the central counterparty, CCP, clearinghouse, however you want to term it, they all have the same role. So I said last leg, but last by no means means least in this sense. It's a vital cog in the work. And a really key step in the process of trading. So I'm going to look at the role of clearing, the services they offer, and ultimately the importance of FIX in this key step. So a CCP is an entity that reduces risk and enhances financial stability between two counterparties, your buyer and your seller. So the main purpose is to manage the risk that could arise if one of those buyer or seller counterparties defaults on said trade or deal. So what a CCP does is it steps in to novate that trade, and it becomes, or what we mean by novation or to novate a trade is it becomes a buyer to every seller and the seller to every buyer. And what this ultimately does is provide a guarantee that trades will settle. It does this by securing margin from participants, and margin can probably be defined as, or thought of as deposit, if you like. What a CCP also does then is ensure participant anonymity. So your counterparty A that's selling and counterparty B that's buying will likely never know who is who. So most venues will actually stipulate in Europe that participants require a clearing participant to guarantee trades, and every clearing participant requires a settlement agent at the domestic CSD level. This ultimately ensures minimal market disruption and full fungibility at domestic CSD. So what do I mean by CSD? It's the Central Security Depository, so the institution that ultimately holds financial instruments. We're talking a lot about equities in this case, so equities, but that also includes any other kind of financial instruments you can think of. So in summary, I guess, in terms of the clearinghouse and its role, it's there to provide a guarantee to the market that the trades will sell and that ultimately nothing goes wrong in a risk sense. Looking at the services then that most clearinghouses will offer. So trade receipt and validation. So the validation at exchange level, that a trade is good. I mentioned before the trade innovation, becoming that buyer to a seller and a seller to a buyer. Trade netting then, so this is a pretty key step when we talk about efficiency and optimal setup. So imagine you're doing, 100 trades in one particular ISIN. You wouldn't want those trades settling on an individual basis. So gross trades come down from venues. And what a clearinghouse will do is net those positions into one or two shapes. and therefore only settling into 1 or 2 trades at the end of the day. Position management, settlement services I mentioned. So central counterparties will have links out to direct connectivity out to CSDs, or they'll use settlement agents for that. Risk management and default management that I mentioned before, if one party goes astray in a trade deal, and the reporting side of things, which is a pretty vital step when you think about reconciliation in middle and back office terms. So in terms of then kind of landscape in Europe and how it looks at a CCP level. So there are a handful of exchanges that are fully open access. We turn that interoperable, where a multitude of clearinghouses interact with each other and clear a venue. You now have the kind of next step in open access, if you like, user choice or preferred, if you like. So venues can have a default clearinghouse in place, and by the use of FIX, you can route trades accordingly to an alternate clearinghouse. You then have the various markets in Europe that are still solely set up with one clearinghouse. So on to the technicals then and the importance of FIX. So ultimately, trading venues connect into clearinghouses via FIX connections. So trades are received into a FIX server in production real time, and that system sends confirmations that I mentioned earlier, a receipt of trading and trade validation back to venues and clearing participants. So trades flow into a centralized platform, netting and account allocation occur. Some clearinghouses will probably use tag 29 for this to route to particular netting accounts. And then that centralized platform is ultimately complemented by a risk management tool that calculates positions and margin requirements in real time. At the end of the day, as I mentioned, trades will be netted and they'll be sent out via settlement instructions to various CSDs. And just to give you an example then, in terms of the importance of FIX, so the particular firm that I work for are connected to 47 venues, 70% of which utilize FIX connections. And volumes wise, when those 47 venues, 1.79 billion trades with a notional of 47 billion a day. So really, accentuating the importance of FIX as a communication tool in the industry. If you're anything like me and prefer pictures over writing, then this slide here basically annotates what I said nicely. So top layer, at trading platform level, you've got your validation, execution, trade matching, gross trades flow down to the clearinghouse, innovation, netting, margining, and settlement instructions ultimately then flow in a netted shape out to the CSD on an end of day basis.
Right, good afternoon, everyone. So as it was previously explained, the buy-side trading desk will receive an order on their part from portfolio managers, and there is a number of data that is required in the trading process. And really, we can split that into 2 sections. So at the top of the slide, there is the operational side, so the operational data that will actually ensure all necessary information is captured throughout the trade lifecycle for identification and regulatory reporting requirements. So the operational data includes information such as the LEI, which is the legal entity identifier that enables unique identification of legal entities participating in financial transactions. You also have the MIC, so that is the market identifier code that is used to identify trading venues and really where the trade took place. You have the ISIN, the International Securities Identification Number, which enables to identify a financial instrument. You have some identifiers that are maybe a bit more specific to an asset class. So for example, the UPI, the Unique Product Identifier, that is actually a new standard that was published in the autumn of 2021, and that enables the identification of certain types of derivative products. You have other fields such as the MiFID flags. You also have, as was previously mentioned, the share trading obligation, which will determine where you are allowed to trade for an EU firm. So just below that, you have the best execution process. So first of all, what is best execution? So MiFID II, which is a regulation that was introduced in January 2018, requires firms to take all sufficient steps when executing orders to obtain the best possible result for their clients. And that is taking into account several factors such as price, cost, speed, likelihood of execution, settlement, things like that. So to ensure that you can obtain that best execution, it is a process. It has become a process. And you need to access accurate data really at 3 different stages. So you have the pre-trade stage, the at-trade, and the post-trade. And the post-trade information that you get then can be fed back into your pre-trade intelligence, and then you can decide to adjust your broker selection or your execution strategy based on that. I think it is also worth actually noting that the UK and the EU are looking at establishing a post-trade consolidated tape for both equities and non-equities. And that consolidated tape will help provide some of that information that is needed in the best execution process. So FIX has been involved to ensure that correct standards are in place to ensure data quality and to make sure that the consolidated tape we are going to see emerge in the UK and in the EU are one of value. So by all means, if you have any questions in that regard, or if you want to get involved in one of the working groups, by all means, feel free to reach out. For example, just as an example as to what FIX, like the involvement of FIX in terms of the consolidated tape, the use of FIX MMT has been mandated to align trade reporting formats and reporting obligations. So that is just one example as to what FIX can help and FIX involvement. So then we are going to look at equity pre-trade transparency. So I know that when you look at the slide, it may look a bit complicated, but there are different type of pre-trade transparency requirement depending on the type of venue where the trade is taking place. So firstly, what is pre-trade transparency? It aims to give investors access to information on current orders and executable quotes before the trade is executed. And that is to help with price formation and help investment firms and banks, again, to provide best execution to their clients. So regulated markets and MTFs, if they operate lead books, they are obliged to continuously publish current bid and offer price for equity and equity-like instruments. If those venues operate dark books, you have four waivers that national competent authorities, which are the national regulators for financial services, may grant to exempt firms from making public their quotes before the execution of a transaction. Those waivers are the reference price waiver, the negotiated trade waiver, the order management facility waiver, and the large in-scale waiver. Similarly, systematic internalizers will have to make public their quotes if they are trading in liquid instruments. If they are not trading in liquid instrument, they are exempt from pre-trade transparency. And finally, OTC, which is over-the-counter, is exempt from pre-trade transparency. So now if we look at what is happening from a post-trade transparency. So trading venues are obliged to publish the price, the volume, and time of the transaction executed on their trading venue as close to real time as it is technically possible. So for regulated markets and FTF, this is going to be as close to real time as possible. SI and OTC, the post-trade transparency will be T plus 1 minute, and the reporting will be done via an APM. National competent authorities may allow trading venues to defer the publication of a transaction in particular for like, for example, transactions that are large in scale, sorry, compared with the normal market size.
Cool. I guess, again, if you're anything like me for pictures or a text, this is really just a summary slide of what we've been talking about for the last 40 minutes in terms of, you know, FIX really being key to the industry as a communication tool. You know, right from the start with the OMS, EMS, so Order Management System, Execution Management System, and right to the end, both on a settlement level and a market data level that Charlotte's just been touching upon. That's just a nice graphic that kind of summarizes everything there. So, in terms of next steps then, so I wanted to mention, or give a shout out at least to the mentoring scheme. So this was put in place at the start of lockdown, which was 2 years ago now, but is entering phase 2 now. So it's, I guess a lot of you are probably, involved in some sort of mentoring scheme internally at work, but this gives you guys, kind of great exposure across industry really. You know, we've got a whole host of various different members, and you would be set up with someone from a different firm, so really giving you a good exposure across the industry. So if you want to get involved in that, either as a mentor or otherwise, please get in touch with Fix at fixtrain.org. So I know we've been chatting a lot for 40 minutes on this particular session, but I guess what we'd like to do as well is kind of open it up for feedback in terms of what other sessions we could look at if we want to look at other asset classes for any kind of future webinars. And finally, prudent to mention that after 2 long years of COVID and lockdown, we've all been in the same boat. Finally have a face-to-face FIX EMEA trading conference on Thursday, the 24th of March. So I guess be there or be square. Kind of all from me. I will open it up to Q&A. I think there are some questions in there already, but
so some questions did come through. And listen to me. Don't have it open while you're trying to present because it can distract you. So the first question that came through, yeah, I see it on the chat, and I think Alex, this one would probably be in line with what you presented today. What defines tag 851? This is from Holger. So taker taking or maker making providing is in the end the same thing? Question mark. Is that true or not? And buy side is in most cases initiating the order. So I think he's asking the question here: is buy side in most cases initiating the order?
Sure. Okay. Thanks, Merlin. So originally, the tag 851 was put in to just simply determine whether that particular execution had resulted from either adding liquidity, i.e., that order was already sat on an order book, and someone came in and executed the other side of it, or if that order had removed liquidity, i.e., there was an order already sitting on the book, and your order came in and executed against it. So a given order could execute in a number of ways. You could have one execution that would have added liquidity and a different execution that would have removed liquidity. It really depends on what the order book is doing at the time. So it's less about who originated the order and more about, on that particular order that's sitting on the venue's order book, whether that whether that was resting and someone came in to take it, or vice versa. Since the tag was originally designed, it's been expanded to encompass a number of other scenarios to give more information to the buy side about orders that they may not be able to get purely from the tag 30 or the last market, the MIT code that the venue executed on. For example, there's a value for auction executions, so that buy side can see whether their order executed in auction. And similarly, there's another value for conditional orders. These are orders that were submitted that require a separate firm order commitment prior to the execution. And these are often used by venues or order books, what we would call block trading or large in scale or LIS trading venues. hopefully that answers the question.
Thanks, Alex. That was great. And yeah, please, if you have any more questions, keep it coming. There is a question here from Emma. I did reply to this, but Emma's question is, can we send a FIX order directly to the sell side without the FIX Hub participation? And the answer is correct. You can. You can have a lease line directly to your executing broker or the JC trading member, and we see that quite often in the case of proprietary trading firms, for example, would have their servers in co-located environments trading directly through a sell-side firm. But there's plenty of scenarios we could have went through there. But to answer your question, yes. So somebody wrote, will the slide deck be available to us? Somebody else asked as well, can you share the presentation, without the audio and video recording? I don't know if I should feel hurt about that. Yeah, but yeah, so I think at this time, maybe it's a good time to say, this recording will be run under the Chatham House rules like we do for all events, just to make sure we cover ourselves. Maria did reply. She's willing to share the deck with you guys at a later stage, and we'll make a decision on the video going forward. So another question, I'm going to just throw it out to the panel if anybody wants to answer it. Otherwise, I can give it a shot. This is from Jonathan. Is there any differences in terms of how to use FIX in other regions like APAC or the US? I'll give you 5 seconds and I'll take it.
Yeah,
Alex, go.
I mean, I can take a bit of that. I say from a technical perspective, no. The protocol is the same used in all regions. There may be some differences in terms of the fields that you would use for different regions. A good example, we've just been talking about tag 851. A lot of trading venues in Asia don't support tag 851, which is something that we are, as a fixed trading community, trying to work on and encourage them to do so to get some more consistency across different regions. But yeah, I don't know, Madeline, if you wanted to expand on that at all.
Yeah, no, I think you covered it exactly what I was going to say as well. It's a standard set of messages. You do find some firms end up customizing it at certain scenarios, but that's to your detriment. Please try and align as closely as possible to the standards. So, when you're expanding and developing further, then you align to your peers. There is another question. Where can we find a full specification of fixed messaging, including all the message types, tags, and values applicable or allowable? I'll take that. If anybody else wants to take that, anybody?
Go ahead.
Oh, okay. I was going to say, as a member of FIX, this is one of the perks, and there's a full library available on the site. As well as being a member, you have access to some of the experts in the FIX community. So please have a look on the website. You should be able to download the specifications. If you're having any issues, please just reach out to us or the team, and we'll come back to you. Another question.
Sorry, yeah. Sorry, Madeline. There's a tool on the website called FIXimate, which you can find. It's just fiximate.fixtrading.org, and that is a really good online library of all the different fix tags. And in fact, it's one of the pages that I've got up as we are talking through the presentation to help me out. So yeah, I found it very helpful. So look that up, and I guess we can circulate the details of that afterwards as well.
Perfect. Thanks, Alex. That's great. Somebody wrote, I think, to Christian's thing about what could we do better, or what could they look forward to in the future. Somebody anonymous wrote, would love to see this seminar on fixed income trading. So I know we've also thought about that internally within this group, and it's something we looked at. We thought we'll just split it out per asset class, but it's definitely on the roadmap. Okay, I don't know if we're going to go really deep into the actual tags, but what does tag 59 equals 5 good till crossing actually mean? What is it supposed to do when it goes to the exchange? Anybody want to take a shot at that? Or I can. Or you could use FIXinar now that Alex has spoken about it. So good till crossing, to be honest, we don't have it in my market. We've got GTC, which means something completely different. That's good to cancel. That we do have a crossing functionality, which is a different tag that allows you to go within the spread when you have both the buyer and seller. Let us come back to you on good till crossing. I'm not sure if anybody else heard of that.
Take that one.
Yeah, please. Thank you.
And this is just my experience, is that with auctions, they happen at a particular time, and if a buy side wants to be part of the auction, but if they don't get any cross in the auction, they don't want that order to stay beyond the auction. So that will be as soon as the auction starts, the order would effectively be cancelled.
Okay, thanks, Maria. Is there a cheat sheet or dictionary of all fixed tags?
Yeah, so that's typically the time in force tag.
The tag 59. Sorry, Sakina. Sakina's been struggling with the reception.
Yeah,
but,
she was referring to tag 59, madam.
Okay, perfect. Yeah, so that's all the questions we have for today. Oh, somebody else wrote a fixed trading site. Are we going to have a new fixed version soon of the fixed trading site? I don't know, Maria.
So there's a new, we're moving away from versioning within Fix. So we now have something called Fix Latest. Now, I'm not a technical expert, so I think possibly that's something that we could put on the agenda for another session, where Fix Latest allows you to use any tags that are available. And it's in use now, and I think we'll find that an awful lot of firms are using it without realizing it. So I think we'll put that on the agenda for another session.
Okay, perfect. Okay, so I think that brings us to a close. Thank you to everybody for joining us. We had well over 100 people join us for this session. We really appreciate your time. I hope you found it valuable. On behalf of my colleagues in the Fix NextGen, we want to thank you, and we hope to speak to you guys soon. Take care.
Thanks, guys, and thank you for all your work on this. Thank you.